Joining us right now is Gartman Letter editor and publisher Dennis Gartman. Dennis, it's great to see you. Welcome.
Oh, Maria, thank you. It's been a long time. You and I go back a long way.
We sure do. And I know for a long time you've been studying this market, looking at technical issues and trying to get a sense of where things go next. We're all eager to understand where you see this market today, given your great work in the past, Dennis.
Well, I'll tell you what. First of all, price-to-earnings multiples are extremely exaggerated. Price-to-value multiples are extremely exaggerated. The psychology is extremely exaggerated. I have found the market to be overbought for a long period of time, but let's be quite honest. It has been a bull market. It continues to be a bull market, and you can write this down. It will continue to be a bull market until it stops. We are at that point where it's just, I mean, what more can one say? It's been an amazing move thus far, and the best that one can say is one of these days we'll walk in, the Dow will be down 200 or 300 or 400 points. It won't rally, and that will mark the top. But until then, every rally has been taking us to new highs. Every low has been at higher levels each time. The fundamentals may be exaggerated. The president may make mistakes, but the market still wants to go higher, and it will continue. What can one say?
It's tough to even follow up on that. That stocks are going to go up until they go down. But you're right. I mean, it's been one day after another. It's almost amazing to come in the morning and see it, Dennis. Although we had a conversation with one of the earlier guests, and I'll bring it up with you as well, is that can we be in an environment where we have higher yields, higher rates, and higher stocks? And can the two coexist? If so, for how long, and how do you see that playing out?
Yes, the two can coexist. I mean, we've seen plenty of times when interest rates have gone higher, and so too have stock prices. They don't have to move in contravention. They don't have to move in convention, but they can do both over different periods of time. It is not unusual to see interest rates rise and stock prices to go higher, and we are in that environment. The economy is doing well, and that's going to drive interest rates higher for the next several years, I think, and we may well see stock prices continue. It's shocking. It surprises people. It has certainly surprised me, but every time you try to take the other side of the market and say it's too high, it goes right in your face and continues to go up.
Well, every time, Dennis, it's Dagan McDowell, every time the 10-year yield has crossed like 2.5%, 2.6%, it was a buying opportunity in treasuries, really since 2008. But how high is too high? Give us a number on the 10-year yield where that would be a negative for the stock market.
Oh, I think, Dagan, first of all, I look forward to playing. My beloved NC State will be playing your beloved Wake Forest sometime in the not-too-distant future. I look forward to beating you on well, how high is too high? Once we start getting above 3.5% on the 10-year, I think that will make things far more tenuous and far more dangerous. But can we take the 10-year to 3.5% over the course of the next 2 or 3 years? Of course we can.
Well,
you have to remember, I can remember trading the bond market when the long bond had a 14.25% coupon. So nothing surprises me, having been in the market as long as I have been.
So, I mean, at 3.5% in the next three years, I mean, does the Fed blow it this upcoming year? They're talking about 4 interest rate hikes. They're talking about unwinding the balance sheet, $50 billion a month. Can they snap this recovery right in its tracks and cause stocks to follow an economy?
Maria, they will if they allow the yield curve to move to an inversion, if they allow the overnight Fed funds rate to get above the 2-year, if they allow the overnight Fed funds rate to get above the 5 and the 10. Let us hope that the Fed has learned the lessons of the past, that when it allows the yield curve to move to an inversion, that recessions follow and bear markets are hard upon.
Right.
Let's hope they've learned that lesson and that we don't see an inverted yield curve. And right now, I don't think that that's going to happen.
All right, so real quick, Dennis, it sounds like you would put new money to work in this market right here.
No, what I would tell you is any 200 or 300 point break on slow volume, on lesser volume that takes a protracted 2 or 3 weeks to evolve, then I would. But would I buy stocks this morning? Not with my money and not with yours. It's still a bull market. Wait for corrections. There shall be one. It'll happen. Wait till you see one when the volume is lesser than we have been. Then you can be a buyer. But would I buy stocks this morning? No, not at all.
Good advice. So would you buy the laggards like energy?
you know, one has to depend on which sort of energy one wants to be involved in. Would I buy a driller? No. Would I buy a refiner? Probably.
Okay.
Would I buy natural gas? Yeah, probably I'd buy that. Those make sense. And if you're going to be a buyer of energy, take a look at some of the trusts. The yields on some of these trusts are extraordinarily high, and they're fairly well defined and fairly well covered. So here we are at $62, $63 WTI.
Yeah.
The trusts probably make the most sense.
Dennis, it's great to see you. Come back soon, please, my friend.
Thank you.
Dennis
Thanks for having me
Gartman
on.
joining us there.